Hey guys, today is Saturday the 6th of August, and just a very short video just talking about non-farm payrolls that happened last night. The payroll numbers came in from the US were really good. So I had a couple of questions from a few people. Just first one being, what is the non-farm payrolls and why is it important? And the second one was, why did gold get smashed? Okay, so I'll just answer the first question. Non-farm payrolls is, as it says itself, is really just the number of new payrolls that are being added or subtracted into the economy each month in the US, whether it's full-time, casual, part-time, or whatever it is. It's just a measure of how many new jobs are being created, all right? But there's a lot more to it than just the numbers going up or down. You got to look at to measure the economy in real terms. It's the payroll number. It gets calculated based on the number of full-time work, right? The number of part-time work, whether they're existing jobs have just been replaced. The age group, the demographics. So is there more full-time work being created for, say between people between the ages of 15 to 24, or is it more jobs being created from, higher ages like 25 to 35 or something like that, So you got to look at it that way. But most people tend to look at demographics. So if less jobs, if the number of full-time work for people between 15 to 24 is decreased, then that's generally a bad sign, because there's not enough work for those people that are coming out of university, less jobs available. Therefore, and you got to remember that a lot of these students in the US have a lot of debt, right? A lot of student debt, like in Australia we have HECS. Same thing with them, right? So a lot of these guys have got a lot of debt that they cannot pay off. So if there's less jobs available for them, it's going to be, in a longer term, it's going to be harder for them to pay off those debts, etc. So you got to look at it that way. Now, you're looking at this little chart here. This is calculated in thousands. So whatever you're looking at, 205 or 267, you got to add, the thousands on top. So it's 267,000, 205,000, and so forth. Now, why is this important? Well, it's important because it's a measure of the economy, whether it's growing or slowing, or there are particular months of the year where it might be a lot less than usual. That's normal. But over a period of time, you want to see a gradual increase in the payroll numbers. Now, the thing about the payroll numbers is, I don't really believe whatever numbers come out, right? So each month they come out with the numbers. I don't really believe it. It's generally, I believe that these numbers are made up pretty much on the day or whatever. This is not really a true reflection of the American economy, right? Now, you don't really know what's going on in the ground. Now, I'm not there to know what's going on, but just from all the data I've seen, the news, the information I've seen out there, a lot of people, there are more people out of work, right? There's more people on food stamps, right? The last time in 2009, I think there was about 20 or 40 million people on food stamps. And that's increased, right? That's probably doubled by now. So these numbers that, they're saying that jobs have increased is really just, this is just an illusion, right? This is just for people to think that the economy is doing well, but really it's not doing well, right? Now, the question is going to be asked as to why would they do this, right? Now, there's plenty of reasons why they would do that. And I'm not going to get into it because it's just a long discussion, right? But the important thing to remember, if you're trading or whatever it is, that the number is not important, right? It's how the market reacts, right? So whether the number is 300,000 or 200,000, that's not important to me. It's how the market reacts. Now, generally, when the numbers are good, the market will react positively, right? Therefore, the stock market will go up. If the numbers are down, right, then generally the market will react negatively and sell off, right? So that's how it works, right? But in the longer term, right, this is all short-term trading, okay? In the longer term, that's what happens in the longer term that really matters, right? So this is up until January, but I don't have a chart that shows up until today. So but I think the numbers were pretty good, right? So although this particular non-farm payrolls, which happens every first Friday of the month, is important, is very important in terms of driving the market up and down in the short term. You know, like I wouldn't be using this as a way to, you know, determine, you know, your investment strategy, you know, in the short term or longer term, because this is an illusion. Okay, so that's the first thing. Now, someone asked me if why did gold get smashed, right? Now, gold got smashed for a couple of reasons, right? And this was no surprise, right? This is no surprise at all. So what I'll do is I'll delete this, and what I'll do is I'll put a comparison of the S&P 500 chart, which is the stock market, and I'll show you why. Because this is nothing really, you know, this was expected. Okay, so what I'll do is I'll make it a line chart, and I'll make it blue, and I'll make this one. Hold on, let me just go there, make it a line chart as well, and I'll keep it as black. Okay, make this one red, I'll make it a bit thicker as well. Okay, so you can see here, right? Now you got to really look at this. Okay, that's the best I can do, I think. Now you can see here at this point here, you know, after the non-farm payrolls came out, the stock market went up and gold went down, right? Now, generally, the stock market and the gold market trade inversely to each other. Okay, so when one goes up, the other one goes down. Now, sometimes they do trade together, like here, where you get here, right? Sometimes they do. I'm not going to kind of go into why, but they do sometimes trade together, right? But most of the time they trade inversely to each other here. Like you can see here, right? It's very inverse to each other, right? You can see these gaps here. And you can see here that, you know, when the stock, I'll put there, and I'll see if I can, I can't do all of this, but yeah, you can see here at the top here, you can see how it's very inverse to each other, right? So, you know, most of the time they do trade inversely to each other, and that's just how it is, right? Because gold is a fear trade, right? When the economy is slowing down, or when there's something wrong in the economy, people tend to turn to gold, right? And they'll buy gold up, and the stock market will be heading down. So that's the general reason why. But you know, if I look at it from a technical level, right? If I look from a technical level, you know, gold is at a major decision level. Okay, so we had this big up move here, right? And now we're heading into an important resistance level, right? So the golden rule is that what goes up must come down, right? So the market had a big run up, right? And it's, you know, it's only natural for the stock market to take a bit of a breather. I mean, the gold market, sorry. You know, so this is where you're going to start to see some profit taking. We might see some more downside, right? But you know, this is still a bullish pattern, right? This is still setting up for higher prices, right? This is just taking a breather, like this one here. You know, we had this big up move here, right? Let me just delete that. We had this big up move here, right? And then the market just consolidated a little bit, right? And we had some profit taking, slowed down before we had the next big move up. Now the same thing's happening here, right? We're likely to see some sideways movement, you know, maybe another move down, who knows? But this is setting up for a bigger move up, right? So you just got to look at price action, right? Look at price action and see here, like here for example, right? We had this big move up here, right? Going up there, and then we had some sideways action. Then the market broke down and came back up to retest, then came back down to put in another low, right? Now, when the market did come back up, right? When it came back up, it was only natural for it to do the same thing again, do a bit of sideways movement, do a little bit of profit taking, and then head back up, right? That's because if you look left, you know, you can see that this was a major resistance level. This was a major level that sellers started to take profits, or buyers started to take profits. So it's only natural for it to, when it came back up again to that level, that you're going to start to see the same thing, right? That's normal. So So gold moving down was no surprise, right? From a technical level, it made sense. From a fundamentals level, it made sense as well because non-farm payrolls data was good. Investors or traders, reacted positively and drove the market up, which therefore drives the commodities market down. Okay, so you would see that across all the other metals markets, and so forth. So that's, hopefully that answers the question. But again, don't look at the payroll numbers as being the real measurement of the economy, right? It's a short term. It's really short term, right? So and it depends on how the market reacts. Even if the numbers are good, the market might react negatively. Okay, and like I said, the payroll numbers are just an illusion. Okay, so don't look at it and think that the economy is doing well. It's not at all. Okay. And that's why you got to do your own research and look at other markets, look into the news, see what's going on, and you'll get a better understanding of what the sentiment really is. Okay, but you got to understand that economies, big governments, don't want people to think everything is bad, right? If it's bad, they'll play with the numbers to make everything look good, to make everyone feel comfortable, right? Because once people know things are bad, people will start reacting or doing certain things that they don't want. So, and this is the illusion behind it, is to keep the market, keep investors, keep mums and dads thinking that everything's okay until something happens, until a big crash happens, and then everyone will be called out and be more confused and so that's the best way I can do to explain. I don't want to really go into too much, but yeah, hopefully that helps, and I'll leave it there. Cheers, bye.